Good afternoon, Ian. Welcome to Better Capital Club. So good to have you again. How are you doing?
I'm great. Thanks, Jason. Thanks for having me back.
Um, from the last time, a lot of the viewers really understood the benefits of not trying to time the market. I heard that today you're going to share with us a few graphs. And is there anything that you like to tell the viewers about the state of the market and why market timing is bad?
Sure. Yeah. Yeah, I know there's a lot of I think the psychology of all of us is to want more certainty when things seem more uncertain, and you see people losing money in the markets. And in contrast, sometimes we see people doing so well in the markets that there's a lot of what you could say is contrarian voices in social media saying things can't go on like this forever. Get out now while you can. All that stuff. I mean, it's totally normal to want some kind of sense of certainty about what's going on. So we look for Wall Street Journal articles that will tell us, why did the market do what we saw it do yesterday? And that sells papers, and it has been the thing that sells papers for decades, a century or more in America. Is just the Wall Street Journal talking about why the market did what it did or has been doing what it's doing. The reality is no one really knows. All you have is kind of a plurality of opinions on what is driving this or that today. Even when you're talking about a specific stock like Apple and it goes up after earnings were announced, people will say, "Oh, it's gone up because they beat earnings." Well, you might have a separate earnings day where the stock beats earnings but then falls, and people will come up with another reason of why it's fallen related to that same earnings report. So there's really it's our human minds looking for an explanation for things. The reporters do it, we all do it. And so what I try to help people with is to break out of that psychological tendency that ends up, not only being worth ignoring, but it's actually, we'll do a lot better with our investments if we ignore that stuff.
Absolutely. Thank you so much for going over that. And folks, today we're so lucky because Ian has prepared a few different slides that we would like to go over. So without further ado, so Ian, what do you think about market behaviors and how the market is doing? Go
Yeah.
through the
Well,
picture with us.
okay, sure. Well, so basically, the point of this slide is that when you're trying to guess what the market is going to do, which is always happening in everyone's heads, no matter how long they've been playing this game of investing. Even the most experienced investors who are successful are still trying to guess what it's going to do. But what this chart shows is the result of trying to guess. If you look in the left side of the chart, you see that that axis is net new cash flows, and those green bars show new cash flows coming into the market in the late 90s and peaking at about 2000. And then you see it as the stock market falls, which is that red brown line, in the early 2000s, 2001, 2002. What you notice about the green bars is they suddenly turned negative in 2002. What that represented was all the investors on a net basis were pulling their money out. Not all of the investors, but the market as a whole was exiting. And what that did to those investors was it cost them surely years, if not over a decade, to get their money back when they exited at the bottom of the market during 2002. In contrast, the people that stayed in the market and didn't try to second guess whether they should have their money in the markets, they got their money back within a year to 2 years. they were back to where they were. Same thing when you flip over to 2008, you see all the green bars going negative, and that was very costly. I've talked to people who pulled their money out during 2008, and it took them, over a decade to get their money back, just back to square one. So I guess the point of this is that when you have goals that we talked about last time, where you know what the money needs to do for you, and then you implement it with a specific plan. Let's say your plan is, I'm going to put money into the stock market periodically whenever I have filled up my basic buckets of capital that I need to have for emergencies. I'm going to put the excess into the markets on a periodic basis. Let's say that's your plan. Well, your plan should not change based on what the market has done today or this past year, or even based on what people are predicting it's going to do next year. Because the reason your plan shouldn't change is that your goals have not changed. And history shows us that it's been a losing battle whenever people tried to predict the markets.
Ian, I really, really love this graphics because even though this picture doesn't show our most recent crash, even though I knew all the theory that it's bad to market time, I pulled out my money in, 2022 when the NASDAQ was down by a lot. Even though I knew that I should be staying in, but I tried to time the market because it's so easy to do, and all the news around you is kind of bombarding you, saying that tech is crashing, interest rate is rising. It's so hard to implement, in theory, in practice, I mean. And, so I really, really need to, take a big look at this picture to make sure that, I stay the course next time, the market is very turbulent.
Well, Jason, it's not just you. And as I said, every investor is, really fighting, having to sit on their hands to avoid pulling their money out when all the news is negative. Every bit of news is negative, like in 2020. But statistics show that the average market downturn, the bear market in the markets since 1920s, the average time period to go from peak to trough before you start a bull market again is only 50 weeks, roughly. So you can kind of take solace in that fact when the market is dropping, is that this doesn't last forever. On average, you're already seeing a turnaround within 52 weeks. And that's a pretty short amount of time to start getting your money invested when things are, the market is cheaper. But now I can address a little bit more about statistics and the probability if we go to the next slide called the behavior gap. The average investor lags the market index.
Oh, fantastic. Ian, I see this picture. There's various different legs. Can you help our viewers understand what that performance leg is on the picture?
Sure. Yeah, so basically, looking at investor studies, that circle right there around the orange bar is showing the lag between what the average equity fund investor is getting on his money over a 10-year period and what the S&P 500 is doing. And this is a period of around 30 years where they looked at all the market data and what the average equity investor was achieving with his or her money. So it's basically to illustrate that we as individuals are not very successful at just doing the bare minimum of letting our money sit in the market. All of these bars, the blue bars, are what the S&P 500 did over a 3-year period, a 5-year period, a 10-year period. And you can see in all of those cases, the average fund investor was not even capturing the S&P 500 return. That's why you get those orange bars in the bottom. So it's pretty costly. And all this illustrates is that there's a behavior gap between investors being able to, passively put their money into a rules-based system and let it sit there versus trying to jump in and jump out and guess based on what our instinct is just telling us has to be true about what the market's going to do next year.
It's super useful to be able to see this from aggregate level. Thank you, Ian. This is super, super telling on, just on average, market timing will turn out worse. And it's better sometimes just to, be disciplined. And
Yep.
with that, Ian, can you go over, this graph about, it's a good days and the bad days on the market?
Sure. So this is I'll preface this with a little story about Peter Lynch. A lot of people might be familiar with his name, but they might not know he was the manager of the Fidelity Investments Magellan Fund. And between 1977 and 1990, his Magellan Fund averaged 29% annual returns. That was the best performing fund in the world. So what you might assume if you saw that kind of return, 29%, you probably would say this guy probably really knows how to battle the market's moves in the late 70s, the early 80s. I mean, that was a volatile market, and you'd probably assume he's probably got the best intel on when to get out and when to get out, or when to get in and out. But I like these quotes from him about timing the market. He says, "You can never predict the economy. You can't predict the stock market. People spend all this time trying to figure out what time of the year should I make an investment? When should I invest? And it's such a waste of time. It's so futile." He says the stock market has been the best place to be over the last 10 years, 30 years, 100 years. But if you need the money in 1 to 2 years, you shouldn't be buying stocks. So I guess the takeaway from that is that you've got one of the best investors of all time. Not only does he not try to time the market, but he thinks that it's counterproductive to even pay attention to it. The one last quote from him is he says, a lot of people, when they get negative on the market, they put 50% of their capital in cash. But unfortunately, a lot of times when you get to that position, it's just about when the market's going to rally. And that's what this slide is about. So on this left-hand chart, what this shows is that the 50 best performing days that happened in the 30 years ending in 2022, over half of them occurred during bear markets. So in other words, in a time period where if you're trying to time the market, you're probably going to be sitting in cash. You would have missed out on over half of the 50 best performing days over a 30-year period. So that's a lesson to, not try to time the markets. On the right hand, you can actually quantify how much you would have lost. So in that 30-year period, if you'd stayed in fully invested the whole time, your capital that, let's say, would have been 158,000 sitting in the markets, if you'd been started with $10,000, that capital would have only been half, so $70,000, if you had only missed 10 of the best days over those 30 years. And it gets worse and worse if you missed more of those days.
Wow, that is super powerful because, 10 days, 20 days, if you just sit out on those specific days, you're going to lose out on so much. And no one knows when those days are going to be. Um,
Exactly.
that is so tough, Ian. So all the more reason for us to stay disciplined. And, we have this last picture about, it's the S&P 500. Could you help us understand this?
Yeah. So basically, the question somebody might be having right now is, well, how safe is it to put your capital in the stock market when it's so volatile all the time? I mean, we see charts of big drawdowns, 50% drawdowns in the worst recessions. So how do we know that it's safe? Well, this is a pretty simple way of thinking about it, that going back even before the Great Depression of 1929, the stock market crash of 29, if you started the clock in 1926, There's never been a 20-year period where the S&P ended up negative. That's the bottom of that chart. It says 20-year timeframes. There was no 20-year time frame when there was a negative return for the S&P. And if you go up to 10-year periods, let's say you're someone who has a goal of pulling money out of your account in 10 years to buy a house. There's no guarantees in the stock market, but you can look at 100-ish years of stock market returns, and statistics say that 10-year periods, there were only 6% of those 10-year periods that had a negative return. So you can't get any guarantees, but you can look at what statistics would show is most likely to be the case.
Yeah, and that is super useful to know because I don't need to touch my retirement funds for another 20 years. And it's so comforting to me to know that I can lump sum it into the S&P 500 and there's almost 0% probability that in 20 years I will be losing capital. So that's absolutely great to know.
Yeah, and again, the future, it can't be predicted. The past results, which is what we're looking at, doesn't predict the future, but it gives you an example of what somebody would have experienced if they were starting their life in 1926 and their parents had been putting their money in the stock market. You would have thought 1929 comes along, the stock market crashes and doesn't recover for a couple, for over a decade. You would have thought that that person's lifetime would have had a lot of 20-year periods where they were negative, but this is what the outcome was in the past. And I think what we can say about the future is that this illustrates that American business, the American economy has been remarkably resilient. And when you own the S&P 500, you own this exposure to all of the largest companies in the US that not only are exposed to the US, but they do business all over the globe. This is just, kind of to help you get a little bit of comfort that the market is pretty resilient and American businesses do well over the long term.
Ian, today we learned so much from the data that you prepared. We know that we want to be disciplined investors who don't time the market. Where can people find you if they want more advice on asset allocation and financial planning?
Sure, Jason. My website is huntervalue.com, and you can send me emails there. I'm at ian@huntervalue.com, and always happy to take questions from people who are just trying to understand the financial world a little bit better.
Thank you for your time, Ian.